All right, welcome to the Short Vol Show Live. My name is David Lincoln, and we are coming to you live on a Monday morning. Welcome back to the trading week. If you're like me, then you wait over the whole weekend for the trading week to start again, and here we are. And we are in an earnings period right now. I want to update you on some earnings plays we talked about last week in Skechers and CHWY. Look ahead to this week, talk about volatility, talk a little bit about BYND, which has been the real winner for me this summer so far. And let's look ahead to some other opportunities coming up in the earnings landscape. So first of all, the Skechers and CHWY positions that we had on have to report were not entirely successful, and the reason behind that really, I believe, is just these weren't the ideal candidates for this sort of calendar spread that we put on. And I know some of you sort of followed me over the cliff on this. For me, the CHWY one worked out well, and the Skechers one didn't, and mostly due to the fact that, like I said, they weren't ideal candidates for this sort of calendar spread, and I'll explain why in a second. And the Skechers one just moved too far away from strike for it to be to really work out. But the biggest thing with these calendar spreads is just there just not enough premium in the options for it to really work out. So let's get into that real quick here. Let's refresh your memory as far as to what the spreads we traded in Skechers and CHWY were. So we were looking at earnings plays. And if we pull up the options and charts for Skechers here, for example, we can see the move that we had. Earnings was came out before the Friday session. I think it was after the close Thursday. And you can see that it ripped upward. Let me go to a 5-day chart here. That would probably illustrate it better. And let me get out of the way sort of here. Okay, so you can see after the close, earnings come out, and I guess there was positive comments on the conference call as well, and rips upward to, was that a high of 40.50 right after the open, and settled in the right around 39 if you were a little bit patient. So what was the play? Well, with stock trading around 33 and change, we were looking at buying a calendar spread, so buying 2 weeks out options and selling the front week options. So it was setting up where the front week options were almost the same price as the options 2 weeks out. So we figured buy the options 2 weeks out, sell the front ones, and all that premium that was still hanging out with 1 day to go in the front week, we would collect that as earnings came out. But the problem is that, as I said before, there wasn't that much premium in these trades. So we were buying the August 35 call and selling the 2 August 35 call and selling the front week 35 call, and we were paying 20 cents for it. So it's a very small amount of money to outlay, but we move so far away from strike. Now what you're looking at after the fact is how much is that 35 put going to be worth once it's all said and done in August, because in the end, if you're buying the calendar spread, what you're left with after July expires is you're just left with this August 35 call, and the amount of premium that's in the call is going to be reflected in the price of the put. And you can see here with 11 days to go, these puts are basically worthless. Now, I did the 35 calendar and the 35.5 calendar. You can see the 35.5 put worth about 10 cents, 35 put pretty much worthless. And thus, you're buying something for 20 cents that ends up worthless, doesn't work out. It was relatively, a small amount of risk because, you're just betting that 20 cents that you pay for the spread. But once earnings came out and the stock had made its move, I was able to sell out the spreads that I bought for 20 cents for like 10 cents. And if you subtract commissions, if you think maybe a penny each way on commissions, each time you do a spread, that's 2 pennies. So you're talking 4 cents commissions. You end up losing about 14 cents per spread, or $14 per spread. So overall, I basically put out about $500 and ended up losing about $300 of the $500, and probably a similar ratio for other people. And I tried to sell the spreads out pretty close to the open once it had settled a little bit, and it was just, there was no market, and it was just tough. And the problem once again is that we're dealing with such small levels of premium that there's just not enough in it to really make this stuff worthwhile. The real successful times I've done these calendar plays is when you were dealing with like a $200 stock, and you had one put or one call that you were buying for $35, and you're selling another for like $34 against it, and you've got these big premium levels. And in those cases, there's more potential to work with. But when you've got something that's just the option that you're buying is like $1 and the one you're selling is like 70 cents, there's just not enough room to make money there. The CHWY, it didn't really move on earnings. So, the spreads that I bought for 70 cents, I ended up selling for like $1 or $1.10, something like that. And so CHWY ended up working out for me. But it was a very small trade. I bet like $200, and I think I made 95. So that worked out, but really need to look for better candidates. And the better candidates for these trades, once again, are the higher priced stocks. There's more juice and there's more meat when you're dealing with higher priced stocks and volatility. When you could look at this stock and say, oh, well, the front month's a 250 vol or 500 vol, and the second week out is 60 vol. But if 500 vol only represents 40 cents, then it's not really volatility. It's just you might as well just look at the dollar terms when you look at it. Gives you a better understanding of things. I wanted to pull up Twitter just as an example, a similar example of what we were dealing with Skechers, and probably and would make a good example for those of you who were not around when we first put this trade on. If we look at Twitter coming into earnings, this is a similar situation and a similar price stock, and probably one that doesn't have the potential to work out that well. Again, you might make a teeny bit, but so let's look at Twitter here, okay? So the July options are priced at 100 vol, and then the August 9 options are 60 vol. So if we look at, for example, if you assume Twitter's going to have okay earnings and the stock's going to rally, if we looked at like the 26 July, 9 August 40 calendar spread, call spread, if we were to buy the 9 August 40 call, for example, paying 91 cents, and we were to sell the front week 40 call at 71 cents. Okay, so once again, very similar to that Skechers trade, we would be paying 18 cents for this spread. And the contention is that this heads up towards the 40 strike, and this premium in the front week disappears. This goes to 0, and you end up owning this 40 call here worth 83 cents. You end up or I'm sorry, it was this next week out. So you end up owning this 40 call worth like 90 cents here. You're only essentially paying 20 cents for it, since you're selling the front week against it. And so that would be the contention here. The risks are that Twitter goes down and goes way away from the strike, and this call becomes worth very little after earnings. The other risk is that volatility comes in, and instead of 60 vol here, it goes down to like 40 vol. But once again, you're only risking that 20 cents. If we were to look at a more at the money type trade, so maybe the 37 strike, if you were to pay somewhere around $2 for this 9 August 37 call, and then you were to sell the front week 37 call, and you were to put this trade on for 20 cents, once again, there is a possibility that you make money on this because you're only paying 20 cents for the spread. So if earnings come out, it doesn't move that much, you could end up owning this call with 18 days to go. If this stays around 37, obviously this call is going to be worth more than 20 cents. And thus, it could be a decent trade. And this has a little bit more premium than the Skechers one did. But the risk is it moves way away from strike, and this doesn't end up working out for you. But, you give it a shot. Maybe when Twitter a little bit at this at the money strike. The other thing you could look at is, well, maybe Twitter's going to go lower, and you could pick like a lower strike like this 34 put here, or even the 35 put. If you bought the 35 put in August, paying 128, and you sold the July 35 put at 106, or, you paid 20 cents. Everything seems to be coming out to 20 cents here. So you pick a kind of a strip of trades, one at the money, one a little bit to the downside, like these 35 puts, one a little bit to the upside, like the 40 calls, and wherever it goes, you try to make more on that strike that it goes to, then you lose on the other strikes. But once again, you're dealing with options here, okay, that the actual premium in them is $1.08 versus $1.28, something like that. So there's not that much juice in the options. If we were dealing with like $6 versus $5.80, there's more juice there. And even with a vol crush, if you're effectively paying 20 cents for this call that's worth $6, even if the call goes to $3, or a put, even if the put goes to $3, you're still making a decent amount of money on it. So I would look for options when doing these counter spreads that have more juice in them than just $1. However, the ratio of 20 cents versus $1 is a little bit better than 20 cents versus like 40 cents or something that we were dealing with Skechers. So, I might try to put this call spread on small, the 26 July for 9 August 37 call spread. Buy the August 37 call and sell the July one. I might put that on small. 20 cents for that spread. The option premiums are $2, so it's sort of like a 10-to-1 type ratio there, which is a little bit better than the Skechers one. It's just a bummer, though, in Skechers. You pay 20 cents for something, and there's no market to sell it out, really, for decent money. It's like right on the open when markets were wide, it looked like I was making money, but in reality, to sell that stuff out was very difficult. Obviously, Twitter has more liquidity than Skechers, I would say. So there's a shot there to do something with that. All right, let's move on now to BYND, which has really been the workhorse for me this summer so far. And we're seeing this continue to move to the upside. Now, remember, there's earnings coming out this week. Actually, I believe it's the 29th. And we want to be careful because this thing has the potential to make a huge move. So I would say either take your positions off into earnings or pair them way down because for me, I've been short these strangles, okay? So I sold the November strangles, the November 110, 240 strangle, or 110, 230 strangle in BYND. And it's been working out great. The problem is that coming into earnings, it gets a little scary. And so right now I am short 5 of these strangles. And let me try to pull it up on the screen here. November I'm short the 110, 235 strangle. I'm short 5 of those. And I have bought a little protection last week. I did go in and buy with like 8 days to go. I did buy some of these 135 puts, which I paid I think 15 cents for. I did buy some 115 puts, which I paid 5 cents for, and I did buy the 212 call, which I paid 20 cents for. And this is just because when I look at my upside risk, and I look at this, this PNR rate here. Let me move over the way. When I look at my risk here and I see this tells how much the stock would have to move to like blow out your account. And it was showing the stock would only have to move like 40% to blow out my account. And if I just buy this one call for, $20, all of a sudden it gives me a lot more room for this to really rip. Now, it would be pretty hard, in my opinion, for this to rip 50% in one day, just because it's already had some pretty big moves, and it's already pretty lofty, and there seems to be disagreement in which way this should go. So I don't see it making a 50% move. However, regardless of what I see, I want to take my risk, and if I can pay $20 to take off a lot of risk, I'll definitely do that. And as these options are about to expire this week, well, first of all, I'm thinking of probably taking this position off before earnings. But let's say there wasn't earnings this week. I would be looking to, as these protection options where I'm paying 10 or 20 cents for this protection. Remember, I'm short the 235 strike. Well, here I'm buying the 212 strike. So that goes a long way to hedging the 230 strike. But I'm looking to the next week out, and as these options, as it becomes closer to Friday, and these will become the front week, to try to bargain hunt and pay dollar cheap amounts for protection to the upside and the downside, so I can keep my big fat meaty strangle on, but pay dollar cheap amounts to protect it. So if I see that my theta per day is $80, if I can cut that, if I can pay, 1 day's theta to protect my position and to make my numbers look a lot better for like a 20% or 40% move, I'll definitely do that. All right, so we're coming into the open right now, and the VIX has come off the lows a little bit last week. We're up to 14.5 range. Correspondingly, of course, UVXY and VXX have popped up. UVXY off the lows, which I believe it was 24 and change, the lows. UVXY, yeah, 24.95 off the lows. So another opportunity here possibly to sell. But it's hard to tell what volatility is going to do right here, but we are still in contango, so I think it is an opportunity to sell on pops here. And I was looking at an opportunity in VXX. I was looking at the VXX. October options are listed now. I was looking at VXX. October. Was I looking at October? Let's see. I guess I was looking at the SEP. Maybe I was looking at November. And if you look at November, okay, VXX 2330, I was looking at the 25-23 spread in November. 116 days to go. If you can pay 133 for this spread, and all this needs to do is go down by 30 cents in the next 116 days, which, if we stay in contango like this, should be very, very easy to do, and you'll make a decent return on your money. This spread going from $1.33 to being worth $2, as long as we are below that 23 number in 116 days. And that seems very reasonable, considering what we've been doing lately. This has already been as low as 22.29 as we have the opening bell here today. So take a look at that for an idea in VXX. Tell me what you think. And the more of a pop we get, you could even roll up. If we get a pop up $1 or $2, you could roll this from the 25-23 spread up to maybe the 25.5, 23.5 spread if we get a pop. But now with the markets opening up, it seems unlikely that we're going to get a pop upward in VXX. All right. Well, thanks for watching today, folks. I hope you have a good week trading, and I will check in with you tomorrow. I have some free time this week, so I will be putting out videos on a regular basis this week. Please consider supporting me on Patreon. I love to hear from you. I love your ideas, and thanks for watching.